So today's workshop is how to build an investment portfolio that profits in any economy. And I'm sure that most of you have been hearing stuff on the news in regards to a looming recession. And if you haven't heard that, at least you've been feeling the increase in prices. You've been feeling the increase in interest rates. You've been noticing your 401k going down. You've been noticing stock values go down. So, we've heard a lot of information about this recession coming, but most people really don't have a clue what a recession is. And I have to admit, I remember years ago, before I really got into the financial stuff, I didn't know what a recession was either, but I knew it was supposed to be something scary. So I want to give a really quick and brief lesson in economics so we understand what a recession is, so we don't fear a recession, because most people hear that and they just have memories of 2008, 2009 to 2011, where they just lost everything and it was a scary thing. So the first thing we have to understand is that we have what we call an economic cycle. It's also called the business cycle. And if you don't understand that, it is very difficult to profit in any type of investment. It is very difficult to have a successful business. It's very difficult to invest in real estate. It's very difficult to make money at all. And as a matter of fact, you'll be at the whim of the economic cycle if you don't understand and prepare for it. And you'll just be losing money over and over and over and over. So what is this economic cycle? The economic cycle is a constant flux of growth or expansion, peak, decline, trough, growth and expansion, peak, trough, decline. It just goes over and over and over. But the cycle is not well defined in the sense of it stays the same. So it's not like every 5 years. It could be 10 years. It could be 20 years. That it grows. It could be 1 year or even months that it's in decline, or it can be many years. And so we have to really understand that although we know there's a definite cycle and the cycle will happen, that the length of each period of the cycle is not well defined and is dependent on a lot of different factors. So if we look at, let me just go to the next slide. If we look at each phase of the cycle, so when we talk about the expansion cycle, sometimes it's called the recovery cycle because we're coming out of a trough, or the growth cycle. At that time, we see this rapid growth. So we'll see businesses expanding. We'll see houses being built. We'll see massive hiring. We'll see a lot of consumer spending. And all those things, when we look at that phase, we'll see low interest rates, as a matter of fact, which drives that. And so when you see low interest rates, that means it's not a time for people to borrow. It's not a time for people to save. It's a time for people to borrow, right? And so you'll see people take their money out of savings, and you'll see they start borrowing because credit is easier. So they'll start buying big ticket items. They'll start buying a lot of things on credit. They'll start getting mortgages. And what does that do? That makes businesses expand because people are buying. When businesses expand, they hire more people. When they hire more people, they can produce more. They produce more, people buy more. At the same time, when interest rates are low, housing prices, people can afford more house for the money they borrow, so they start spending. What does that do to housing prices? It drives housing prices up. So all that, basically free money or cheap money, causes a growth in the economy, but then we have to fall back to supply and demand. When you have a huge demand and you hit the limit of production, you hit the limit of inventory in real estate, then you start to get inflation. And nothing will stop inflation except when you start intervening. And so the Federal Reserve will then start raising interest rates. When they start raising interest rates, then businesses start to contract, right? So they stop borrowing for expansion. They start laying off people. People don't have the money to buy, and because it's not cheap anymore. People stop applying for mortgages, so housing prices begin to stall, and you start to see the economy contract a little bit. What happens though is all the people who lost their jobs start to default on all the loans that they had. And then you start seeing these massive defaults, and there's a huge correction in the market because housing prices drop way down. Businesses start putting things on sale because they're not getting the sales, and then the cycle starts all over again. So you have this cycle of expansion, contraction, expansion, contraction, and again, there's no defined length for how each cycle happens. The problem is most people make all their economic decisions when times are good. Right? And so they actually make a mistake. So for instance, when we look at the expansion phase, what tends to happen is real estate prices increase. So people say, oh, it's time to get into real estate. And they'll buy when the prices are really high. And then they get stuck usually with something that's not worth what they paid for it, or they can't get the rent out of it that they need because people don't have the jobs. The same thing happens, with people borrowing money. They borrow all this money at the time when everything it seems great, but then they get stuck holding the bag. So people make their financial decisions at the wrong time, right? And so if you make all your decisions when times are good, as soon as things go bad, then you lose everything that you thought you had gained. So even when we look at the stock market, during the worst part of the pandemic, which simulated the same thing as a economic downturn, it simulated a recession. You saw people investing in tech stocks like they were brand new, just dumping money into them, and that made the prices of them go up. And now people who bought those things, when you look at the value of tech stocks, they're in the toilet right now. So they made the decisions at the wrong time. Same thing people did with cryptocurrency. They saw it going through the roof. They bought it and said it's always going to go up. Nothing always goes up. And now they're stuck again with massive losses. So you start seeing this constant poor decisions because people don't understand that there's a cycle. And the same thing happens when the economy contracts. Then people tend to withdraw. They pull out of the market and don't do anything. And so they miss a great opportunity to get things that are on sale. Right? And they miss a great opportunity to shift their money out of things that are losing and put it into things that are either stable, which will prevent them from losing, or something that's growing. So we got to look again at each of these cycles. So during the expansion, I told you what happens. We hit that peak, we come down, and we hit a bottom. But the question is, can you profit from it in the cycle? It's usually too late once you're in the cycle. That's like trying to prepare for the winter in the dead of winter, right? You should have gotten your winter clothes in the fall. You should have gotten your fall clothes in the summer. You should have got your summer clothes in the spring. And it's the same thing when we're talking about making money. It's very difficult once you're in the midst of it to really capitalize on the amount of profits that you should be getting had you prepared at the season before. So we don't wait until we're deep in it to try to make a decision to take advantage of it. We know it's coming, and so we prepare for it ahead of time. So what I want to share with you today is how to prepare ahead of time, because we're definitely headed into a shift in the cycle. You've heard already about some of the changes that are happening. Right now, we know the inflation rate is 6.5%, which is super high, especially when you compare it to what it was in 2020, right? 2020, it was 1.4%. As a matter of fact, for the last 20 years, it hasn't been over 2%. So when you had an average over 20 years of a 2% inflation rate, and then you jump to 6.5%, which is a little bit down. It was 7.1% a few months back, but it's 6.5%. Inflation is through the roof, which means even the money that you have in reserve is worth less because its purchasing power is lower. We saw interest rates increase from almost a record low of 0.25% in March of 2022 to 4.5% currently, which is a huge jump. And the Federal Reserve is saying that they're going to continue to raise the rates until inflation drops to 2%. And I told you inflation is at 6.5%. So they're going to continue to raise the rates until it's 2%. So that could mean this year, another 2 or 3 increases in the interest rate. On I'm sorry, I don't have the number for you, but consumer spending is decreasing significantly, right? Because people don't have the money to spend like they want to, like they had when we first came out of the pandemic. People were spending like crazy. The unemployment rate currently is 3.5%, which is exceptional for the phase of the cycle that we're in, right? Because the goal is always to keep unemployment below 4%. That's the goal of the Federal Reserve when they make decisions, to keep it under 4%. But even though the unemployment rate is 3.5%, there are still labor shortages, which almost it forces businesses to contract, even though the unemployment rate is relatively low. Recently, there was in December, there was a 40% decline in mortgage applications. So what does that mean? There are far fewer people trying to buy homes. When people pull out of the market, what does that do to housing prices? That means they go down because, again, supply and demand, the demand goes down, supply remains the same, then the prices have to come down to compete for those few buyers. So there's a prediction that there'll be 20% decline in prices in at least 183 markets around the United States. And those are major markets in housing. The S&P 500, and when we say the S&P 500, those are the top 500 performing companies in the stock market. And it usually gives you an idea of the health of the stock market. The top 500 companies, that's an index for the stock market, declined 19.4%. So if you had an index fund, and we'll talk about index funds a little later, if you had an index fund that played the S&P 500, your portfolio, if that's with everything you were in, lost almost 20%. So if we are seeing these signs, and I explained to you in this last slide, you know, the signs of each cycle, what does this cycle, I mean, what do these indicators tell us in regards to what cycle we're entering or that we're in? Anybody? And we got like 30 people in here, or 25 people, so somebody should know what these signs tell us. Where are we at?
Unemployment, 3.5, 40% decline in mortgages.
Where are we at in the cycle?
We're currently in a recession.
Are we in a recession? Okay, now let me just, we're definitely in an economic decline, right? Now, and let me just clear up, the term recession means 2 cycles of negative growth in the GDP. So that's a real technical economic term when for the technical term for recession. We haven't had 2 consecutive cycles of negative growth yet, but we probably will, this cycle and the next cycle, business cycle, we'll probably have 2 negative, but we're definitely in a decline, right? So we have all the signs of heading towards the trough, which would, you know, we definitely call a recession. So if we're in an economic decline, we're definitely not on the upswing anymore, we're in a decline. Then before it hits rock bottom, then we got to start thinking about things, because if you do nothing, right, if we have to consider, if you just do what you've always been doing, or you remain in the places based on what you did when we were in that growth cycle, because we were in a growth cycle since 2011. So most of your decisions were based on this long, extremely long growth cycle. So from 2011, that's a long time, to 2000, maybe 21, 22. So at least 10 years, we were in this growth cycle. So you made all of your economic decisions based on that. And you probably put your money in the places that seemed to be making a lot of money at the time. So most people have their money in 3 places, right? They have it in cash, equities, or real estate. So what does that mean? Cash, some form of savings. Equities are stocks, right? And when I say equities, even if you don't have individual stocks, you probably have a 401k or a mutual fund or an index fund or something like that. That's equities, right? So if you have an ETF, a mutual fund, an index fund, a 401k, a TDA, an IRA, then you're in equities, whether you knew it or not, right? That means that's where your money is making its money. And even if you're not a real estate investor, if you own a home, then it's probably in real estate. So most people have their money in 2 of these places. Some people have it in 3 of these places. Some only have it in 1, which is cash. So we know if you have most of your money in cash, in a savings account, a checking account, under your mattress, I don't care where you keep your cash, inflation is just eating it up right now, right? Because you can get far less with your cash than you could before. So every day that inflation is at this level, your cash is just losing value from the time that you actually earned it. If you had your money in equities, in again, one of those areas in the stock market, we know that you lost about 20% of its value last year. And this year is still a little rocky, it doesn't look so great. If you're in real estate, we know the direction, right? We have all the signs of the direction that the value is at. So you're going to start losing equity. And even if you have equity, the cost of borrowing from it right now is so high that it eats away at your ability to use it. So we know that that's happening. So in a down cycle, all 3 of those asset classes just plummet. And we're already seeing the writing on the wall for that. So if that's where your money's at and you do nothing, then you are on the edge of disaster. If we look back at the last recession, which was from 2009 to 2011, and people started losing in real estate, by the way, from 2006. 2006 to 2008 was a mess, but it got worse in all areas from 2009 to 2011. So the actual recession was 2009 to 2011, because that's, again, the technical aspect of it. But we started seeing a decline in 2006. We saw a plummet in the housing crisis in 2008. And then, again, up until 2011, things were bad. But during just that period of 2009 to 2011, $16.4 trillion worth of personal wealth. That's not corporate wealth. That's not, institutional wealth. We're talking about personal, individual wealth. $16.4 trillion was lost during the last recession. And that's about $53,000 per adult, but we know it wasn't evenly distributed that way because people who didn't have anything to lose, right? And so the middle class suffered the most because they didn't make any changes. So people who are well off know how to shift their money out of places that are losing money. People who are poor don't have money out there to lose, so their situation didn't change. But the middle class was just destroyed, lost a lot of money. So on average, it lost far more than $53,000, right? But this just kind of lumps everybody in, all the zeros also. But if we look at just the first 3 quarters of 2022, and the numbers are just starting to come out for the 4th quarter, in just 3 quarters of 2022, American households lost $6.8 trillion already. And again, that doesn't count the 4th quarter, doesn't count where we're at currently because people are still losing. That's the 2nd fastest drop in American history. So by the time we do officially hit that trough, by the time we officially get to that recession, the losses could be double that easily. So you have to do something to prepare. Now, here's the good thing. That's the scary part. If you don't do anything, I promise you, if you have money out there, you're going to lose it. But here's the good thing. You could also be on the verge of huge success. What most people don't understand is that wealth never disappears. It only shifts from one place to another. And that's a hard concept for people to understand when they're losing it. But just to give you an example, we talked about a housing crisis, before, where people paid a certain amount for the house. The house was upside down, meaning it wasn't worth what they paid for. Many of them went into foreclosures. We had record foreclosures. The banks took the houses back. What the banks do, they sold it cheap to somebody else. They wrote it off as a tax write-off, so they got their money back. It wasn't a loss for the bank. The bank then sold it either at an auction or as what you call a bank-owned property after the fact. And they sold it at huge discounts. So somebody else picked it up at a discount. And then all of a sudden they got equity out of it. So the wealth didn't disappear from the real estate. Somebody lost the wealth, lost its value. The bank got value. The bank transferred value to somebody else. They made money. The same thing happens when you talk about, if the stock market is going down, people pull money out of there and they put it into something else like a bond. The bond makes money. The bond pays out money. Money's just, wealth is transferred from one place to another. And if you can position yourself in the right place at the right time, then you don't have to worry about big losses, because while one thing is losing, something else is gaining. But if you limit yourself to a small portfolio with very few asset classes that are what we call coupled, meaning that they're closely correlated, real estate, stock market, and cash are closely correlated. When one goes down, they all go down. Even if you had it in just three things that were uncorrelated, meaning when stocks go down, bonds tend to go up, right? When bonds go up, interest rates go up, so savings goes up. If you had just had those uncorrelated, then you wouldn't have lost money, right? You could at least mitigate your losses. So what I want to share with you is how to take advantage of what's going on. So how do you begin? The first thing you have to understand is that there is no single asset class or investment vehicle that remains profitable in every part of the cycle. There is no universally profitable investment or even asset class that will span every part of the cycle that will be very profitable. So the goal is, again, to have uncorrelated assets that will pick up the slack. So when one is down, the other one picks up the slack. You don't lose, or you don't lose much. So what we want to do is we want to look at our portfolio in a long term, right? We always want to play the long game. If you only look at it in each cycle, you're still going to lose, right? Because we want to target an average return over a long period of time. When I say a long period of time, I'm talking about 20 years or more. Most of us on here have 20 years, right? That's the goal. We at least have 20 years left. And we want to be able to capitalize on that long-term average return. So the question is, what is a good average target return on investment over a 20-year period? Now, consider again that the average inflation rate over 20 years, the last 20 years, has been 2.67%. So we know we want to beat 2.67% for our money just to remain the same in terms of purchasing power, right? So we have to get that. And just to give you a note about how poorly we make decisions, most people who have a savings account, the average savings account currently is paying 0.25%. So if your money's in the average savings account and the inflation rate's been 2.67 over the last 20 years, but we know it's extremely high, you know you've been losing money for the last 20 years. So when we think of a good target average return on investment, we know we have to beat 2.67. But what do you think is reasonable, manageable, again, going up and down the cycle? Now, let me tell you this. Over a 20-year period, an index fund, which plays, again, the S&P 500, even though we saw it lose 20% last year, over a 20-year period will average 10%. Even with a 20% loss, if you go over a 20-year period, will average 10%, right? So what is a good target number for us that's manageable if we have a portfolio that's diverse? Any guesses? Kind of gave you the clue.
10%.
Yeah, let's try 10%. Good answer. Let's try 10% and see what that does. So if we look at, and we have to understand why it works in terms of averages, because we have to understand compounded growth. So most of us are used to just linear growth. And if you put your money in a jar at home, or if you put it, in your mattress, then that's compounded growth. Every time you put money in there, you just add to it, but it doesn't grow any greater than what you put into it. That's linear growth, right? So we don't want linear growth. And even, right, so what we want is compounded growth, meaning we want our money to start making money for us so it grows out, right? So it grows like this V, meaning if I have some money, I want to put it in a vehicle that's going to give it interest or some type of return. So if we say interest, so if we had let's say we had $1,000 and it has 10%, because that's the number we're shooting for. Next year, I'll have $1,100. If I leave that $100 in there, which is the goal, and I get 10% again, I'm not getting 10% on $1,000. I'm getting 10% on $1,100, right? So that means the next year I got $110 from it, right? And so what happens over time, it starts to grow. We grow exponentially. That's why we're looking for an average of 10%, and we're looking at a period of 20 years. So now I mentioned if I had $1,000, that's if I had $1,000 and did nothing. But if I had $1,000, right, and I can invest another $1,000 every month for 20 years at an average return of 10%. In 20 years, that adds up to $730,714.23, right? But that's on $240,000 principal. So $1,000 initial, $1,000 a month for 20 years. With your linear growth, it would only be $240,000, which some of you think is good, which, yeah, if you're disciplined, that's pretty good. However, you could have at 10% gotten $489,714.23 interest, which brings us to the $730,000. So clearly, the more principal you start with, or the more you add every month, the greater your return is going to be over that 20-year period. So we just have to keep that in mind. That number 10% is phenomenal, right? And that's starting with $1,000. And most of you should be able to start with $1,000. And even though we're talking about $1,000, we're talking about spreading that $1,000 out. We're going to diversify that $1,000 because we want to get an average, right? You could say, okay, I could get that from an index fund if I'm just disciplined and I just stay with the index fund. But you'll have long periods, like right now, last year, a loss of 20%. You can mitigate that loss by spreading that out and putting it in things that don't lose. They may not reach 10% during a down cycle, but they'll get 4%, 5%, 6%, right? Which brings our average up, because during the good years, an index fund makes way more than 10%, right? It averaged 10% even with the losses. So there are years, like I think in 2020 was like 20 or 21% return. So when you had 21%, if you could have offset that 10% loss with a 6% gain, then you're still above your 10%, right? And so when we think about this, we can't be thinking, I want to go into something that averages 10%. No, I want to average 10% across the board all the time. So when one thing is up and something else is down, something else is up and something's down, we want to keep making that money across the board. And if any of this is going over your head, please stop me and just let me know, and I'll try to explain it a little better. Okay, good. So far we're on the same page. All right, so we know we want compounded growth, and I just gave you the secret to the long game. The long game means that you have to be able to win in any economy. And in order to win in any economy, you have to have a healthy mix of investments, right? Because as I said in the beginning, there's no single investment that is good for every cycle. There's no single investment that over 20 years is probably going to pay you anything. You know, we have to understand some companies go up and down so fast now, we got to be in and out of those, right? So what we want to do is use a lot of different asset classes, right? And that's called diversification. And I'm going to talk about the different asset classes, but then we want to go a step further. So some people will say diversify into an asset class, meaning have something in real estate, have something in stocks, have something in bonds, have something in cash and its equivalents. And they say, okay, just do that. But that's even risky, because and you leaving money on the table, because all stocks are not bad. So maybe we stay in the stock sectors that are good, right? We heavily weight that and leave some money there. Because if we're going to leave something in stocks, why would we leave it in the stuff that's losing? Let's put it in the areas that are making money. If we're going to leave money in real estate, then some parts of real estate are not doing well. Why not just kind of weight it differently? So we want to do what we call horizontal diversification, which means putting it in different asset classes. And then we want to do vertical, we want to do vertical also, meaning we put it in different investment types within that asset class. So we want to spread it out two different ways, different asset classes and different investment types, even within the asset class, right? So that's the way that's the big secret to really making it work. So how do we go about building this portfolio? Now, I know a lot of people have heard about these age rules, right? They say when you're a certain age, you should have 60% equities and 40% fixed, meaning 60% stock market, 40% bonds. And then when you get another age, you should have 40% in equities and 60% fixed. And the problem with that is during certain cycles, you leave a lot of money on the table. That means if you have a fixed portfolio, but the economy is constantly changing, and you only made that decision based on your age because you think it's too risky, it's only risky when you don't understand what's going on. And it's only and it's a fool's game to try to do what they call dollar cost averaging, meaning leave it 40% equities and 60% bonds, even though bonds for a long period during that recovery period we're paying less than the inflation rate, where the bulk of your money would be. And even though the stock market was booming, only have 40% because that's risky. That's foolish. That makes no sense to make a portfolio based on your age. And even if you want to mitigate risk, there's ways, again, if you do horizontal and vertical diversification, where you're going to mitigate the risk. So it's only when you're lazy or your financial advisor is lazy that you follow these rules of thumb that really don't apply to most people. It's just a simple way to be lazy, and it's a fool's game. You're not going to maximize your money. So if you really want to take advantage of things, you can't do that. Your goal is to consistently attempt to beat the inflation rate, because that's the long game, right? If inflation, again, over the last 20 years was 2.7% and rarely ever goes over 4%, except like we're in an anomalous time right now, but rarely goes over 4%. If we get 10%, we're good, right? We're going to beat inflation. Our money is going to still be able to give us a good return many years from the time that we put it in, right? So we always want to beat that. Will there be times when you can't beat the inflation rate? Absolutely. It'll be very difficult to beat the inflation rate right now with every asset that you have. However, you also can mitigate the loss, right? You can manage that loss by having things that are close to it, as opposed to if you just, again, had it in equities, your 401k is trash right now, your index fund is trash right now. If you just kept it in those safe, what you thought were safe places during a high period, you're going to lose even more. We want to seek a long-term average of 10%, which we just said. Now, here is my risk mitigating strategy. I call it the 90-10 strategy. So we want to keep 90% of our investment in things that are relatively safe or less risky for that period, for that period of the cycle, and 10% of our stuff in risky things that could make a lot of money in that cycle. So we're not going for the get rich quick. We're going for the long game. So for the long game says 90% in things that can get us our 10% average, 10% in things that'll give us a windfall, right? And I think most people, unfortunately, do it the opposite. They bet the house on a windfall, you know, like I ain't gonna get on you crypto people, but people bet the house on the crypto and it's in the toilet. It was too speculative, too risky, no history, long story about that. But we don't put our stuff in things that are speculative. We put our 90% in things that are tried, true, and tested over decades that we know over the long game are going to give us that 10% that we need. Then we'll take 10% and we'll put it in. And that's again, if you're not, if you're not risk adverse, you take just 10% and put it in things that could get you a windfall, because the 90% will make up for if you lose that 10%. We also want to maintain a constant mix. Now, here's the trick with periodic rebalancing based on the economic cycle. So when we see signs of changes in the economy, and there'll always be signs, right? We're seeing the signs right now. The writing is on the wall. We're going in a recession. If you don't pay attention, you're just crazy. but we also start seeing signs of recovery. So if we start seeing lowering of interest rates, then we know that's a sign. If we start seeing the unemployment rate go down, we know that's a sign. If we start seeing housing prices or housing sales go up, that's a sign. Like, we just can start looking at different things, we'll know that's a sign when it starts to recover. So you'll see the signs before we actually get full blown into it. So you'll be able to make your decisions, pretty quickly. It was a question. So a year ago, you do 90% index and 10% bonds? No, because that's only 2 asset classes. So that's a good question. Well, we don't put 90%. We don't put 90% in any single asset class, nor do we put it in any single investment type. So even if you're going to do a lot of equities or securities, it doesn't all go in the index per se, right? And then 10% bonds. You still want to have, so for instance, I have 4 different types of index funds, right? I have a total market fund, I have a large cap S&P 500, I have one that's based on real estate, and I have a bond fund, right? So those are all different index funds. Even though they were index funds during the time index funds were doing well, I still didn't bet the house all on one type of index fund. And even though I had that as equities, I still had my personal portfolio of stocks that I chose, where I have a portfolio of about maybe 25, 30 different stocks that I own separate, right? Because the index fund is a passive investment, and then my stock portfolio is an active portfolio. And just to give you an example, while the index funds, while the S&P 500 went down 20% last year, my personal portfolio went up 5.4%. So because I was able to rebalance, and that's the difference. You can't rebalance the index fund. I was able to rebalance my personal portfolio and weight it differently so that where certain things lost, I was still gaining, right? So where everybody was losing in the tech sector, and I was telling everybody to get out of tech, I moved into the energy sector early. So then energy went up through the roof. So I think we have to be conscious of not finding that one thing that we think can make us all the money and dumping it all there. Don't bet the house there. So index funds were safe, they were good, but maybe your stock distribution should have been 90 index, 10% your own portfolio, but not your whole portfolio, meaning all asset classes be 90% index fund. Hope that answers the question. All right, so here we go. So let's look at the broad asset classes, because I think sometimes we don't even understand that. And you'll see different names for them, and sometimes they don't include some of the things I have in here. But these are basically the things that most people have access to and most people can afford easily. So when we talk about equities, you've heard of equities. Equity means ownership, share in a profit. That's really what it means, ownership, share in a profit. So when we hear shares, when you buy stocks, they say you own shares of a company. You own a share, a part ownership of a company. So stocks are equities. ETFs are exchange traded funds. An exchange traded fund, an ETF, is a group of stocks from a particular sector. So meaning an energy ETF will have maybe 10 different energy companies in it, right? An index, right? Or it can be an ETF for healthcare, it could be an ETF for whatever sector, consumer staples, it could be whatever. Like I said, it could be whatever sector there is. You have gold ETFs, you can have ETFs for different sectors. And it's a way to own a lot of different companies in a specific sector, which is different from an index fund. An index fund takes an entire index, the NASDAQ or the S&P 500 or the Dow, or so it's very similar, except it's much broader, right? It'll be across different sectors. So the S&P 500 could have 10 sectors represented in it, but they're the top 500 companies across the board. And the problem with that is it was heavily weighted. Index funds have been heavily weighted over the last several years with tech companies. And now that we're seeing the tech companies drop, then that S&P 500 is declining, it's dragging down the whole index. Whereas if you were in an ETF, in the right ETF, if you were in an energy ETF, that means you got BP, Exxon, Chevron, you got like a dozen different oil companies where maybe you couldn't afford to buy all the different oil companies individually. Now you have them all in one shot, which diversifies even that sector, right? So even though you're segmenting a sector, you're diversifying within a sector, right? Which again, we always want to diversify because we get the best outcomes. So you have ETFs, you have mutual funds. Mutual funds are like actively managed index funds. So mutual funds are like a hybrid of an ETF and an index fund, right? So a mutual fund could be all tech. It could be all gold mining companies. It could be all healthcare companies. It could be large cap companies. It could be whatever. The difference is there's a fund manager who's constantly moving stuff around to try to beat the market. So he'll buy stuff, sell stuff, buy stuff, sell stuff, and stick it in the fund to try to beat the market. The problem with a mutual fund, which is different than an index funds tend to work out better because since there's so much movement in a mutual fund, there's constant fees being paid because of it. And there's constant taxes being paid on short-term capital gains. So you end up losing a lot of even though the gains look great on paper with a mutual fund, you end up paying so much in fees that it cuts down on your profits. 401ks, I have major issues with a 401k, which is a retirement account, because it acts the same as a mutual fund, except you can't touch your money without a penalty until you're 59 and a half, which I just think is insane. So you end up getting stuck with a declining portfolio that you really can't do much with. Most people don't move things around in their 401k. And then we have real estate investment trusts, which act very similar to mutual funds, except they only deal with real estate and they have to pay you. That's one of the rules of a REIT, is that you get paid dividends constantly. So they can't hold on to any of the profits. So these are equities. Then we have real property. Most of the time when we talk about real property, we talk about real estate. So anything tangible is considered real property. So real estate, commodities, meaning like barrels of oil, precious metals, gold, silver, that's considered real property. Then we have what you call fixed income. Fixed income means that you have a predetermined return that you're going to get at a fixed period of time. So if it's a bond, there's a lifespan of the bond before it matures. It can be from 30 days, it can be to 30 years, depending on the type of bond you get. But you know exactly what you're going to get over that period of time. CDs, certificates of deposits, act almost the same way. They have short-term ones, 12 months, 1 year, 2 years, 3 years, 5-year CDs, which is, it's almost like a savings account that has a maturity date. Then you have different types of loans, right? So whether you're talking about peer-to-peer lending, like the old lending club, Kiva, things like that, or you have crowdfunding, like what's that one in real estate? Crowdfunder, I think it's called, right? They have different types of ways that you can put money out and then get a return on it at a given time at a given interest rate. Then you have cash and cash equivalents, treasury bills. Sometimes treasury bills go up into fixed income. We'll talk about the value of treasury bills in another slide. Commercial paper, bank accounts, and then we have collectibles. I put precious metals here again because some people just collect like coins, which is really almost the same thing as bullion, because unless you have numismatic, that's called numismatics, unless you have a expertise in that, you're usually not going to make more from it than what you would make on the bullion. Nostalgic items, people collect things. NFTs, people tried for a minute, it was a big joke. And again, cryptocurrency, because it had no other value besides being a collectible, I put it in that area. So those are the broad asset classes. So how do we initially weight? We want to be able to weight our portfolio and figure out how do we do it, right? What is the percentage of risk in each position? How much do we put in each position? What asset classes do we most heavily weight? Now, there's a myth that you can't afford to be in every asset class. And so people tend to make their decisions based on that. Because I hear people say all the time, well, I'm just going to start off with a bank account or a CD because I can't afford to buy stocks, or I can't afford to do crowdfunding, or I can't afford, to get bonds. But you can. If you have, most of these things take between $25 and $100 to get in. That's it. Between $25 and $100 to get in. So if you have $1,000 to start putting away, you still need to split that $1,000 up over a bunch of different asset classes, even if you only have $25 in one and $100 in another, and so forth. So the bulk of your initial weighting should be in what is most secure, right? Because we talk about a 90%, and profitable in this part of the business cycle. That's important. Most secure and most profitable in this part of the business cycle. So we know where we're at in the business cycle. So let's start digging into this. So I'm going to give you the cheat sheet. I'm going to give it away to you today. 90% of our strategy for this cycle should be weighted initially in like this, right? So I'm not going to tell you the particular investment. I'm going to tell you the class. You still got to do a little bit of work because your specific needs will be a little bit different than someone else, in this workshop. But during a recession, cash is king. So you want to have a lot of cash on hand. And what's the reasoning? If we know when we hit rock bottom that all asset prices in the major areas, stocks, real estate, and those areas rapidly drop. And those are the ones that give us the great returns when times are good. If we know that those things decline significantly, right? They call it a correction, significantly during that time. And we also know that interest rates are high, so borrowing is expensive. If you have cash available, the time to go in and scoop things up with cash at a discount is when this thing hits rock bottom. So as we go into this decline, and we're not at the bottom yet, so we haven't seen all the big asset classes hit rock bottom, we want to start stacking up cash. And again, I'm not talking about stacking up cash in your jar, in your closet. I'm not talking about stacking up cash, in your regular savings account that's giving you 0.25% return. I want you to go on bankrate.com and I didn't say or, I want you to go on bankrate.com and nerdwallet.com and click on comparing bank rates right now. And I guarantee you that each of them have high interest savings accounts that are paying over 4% right now. So if we know that the inflation rate usually is under 4%, right? We said over the last 20 years it was about 2.7%. If we know it was 2.7%, we know we can, right now it's not beating the inflation rate because it's extremely high. But we know the target is 2%, then we know this is a decent place to store some cash, right? And mitigate the losses. So the reason I tell you to go on there instead of telling you the different ones, everybody's banking needs are different too. So some offer greater access to ATMs. Some offer checking and savings. Some offer no fees. Some offer low fees. So whatever your banking needs are, you're going to have to compare the level of the interest rate plus all the other banking needs that you have. So go on bankrate.com and NerdWallet and look at their top rated accounts, and you will definitely find things over 4%, right? So that's the safest place because it's FDIC insured. The only way for you to lose that money is if the entire US economy totally collapses. Please mute yourself.
Hold on, can I ask you a question?
Sure.
You said on bankrate.com and nerdwallet.com, they have, you're saying that, can you just say what those accounts are again?
High interest savings and checking accounts.
high interest savings and checkings accounts. Okay, gotcha.
Right. So if you have your money in a bank currently, then literally it takes you maybe 10 minutes to set up one of the accounts and transfer your funds from your bank to one of those accounts, right? And the good thing, when I say savings account, checking account, you have access to it, right? And some of them, the minimum deposit is $100. So you can get a high return with as little as $100, right? So, and you have access to your money because you have access to ATMs. And most of them, even if they don't have their own ATMs, they will reimburse you ATM fees. So make sure you do that. That's the most simple and easiest thing to do. I want you to also go to bankrate.com and nerdwallet.com and look for certificates of deposit, CDs. They have CDs with a 12-month minimum requirement, meaning this, you can't touch your money for 12 months, right? So you're not going to put money you need for every day in a CD, but money that you know you don't need for a whole year, you can drop in a CD, and each of them have CDs paying over 5%. So money you need immediately, you're going to put in a high interest savings, that's 4%. Money that you can hold for a year, and they have different terms. You have 1 year, or they have longer. But the highest return is basically, believe it or not, on the 1 year CDs. And you can automatically renew it, right? So it'll automatically renew if you don't pull it out in the year. So you still get the 5%, it'll roll over. That's the easiest thing. So we're already at 5%, you're already making money, right? You're already doing well, and offsets all that stuff in the stock market that was lost to 20%. So I'm not saying pull your money out of the stock market yet. We're going to get to that in a second. But new money, right, or money that's been sitting in a bank account or somewhere else where it's not making money, you can start spreading it out and put some of it here. Now, bonds, we talked about what bonds are basically a loan, right? They're loans to either a municipality, right, a government, or to a company. So there's different types of bonds. I'm going to give you the cheat, right away. We're just going to skip to the cheat. The Series I bond, and had you done it last year, and it was 9.62% fixed. Currently, though, it's still 6.89% fixed, guaranteed. The difference is a Series I bond, you got to leave for 5 years, right? So it has a maturity of 5 years. So bank account, no limit. You can put it in today, pull it out tomorrow. A CD, 1 year, you got to leave it there to get to maturity. Series I bond, 5 years to get to maturity, but 6.89% annually guaranteed. Now, there's a time window that you want to get in on this, because the Series I bond is based on the inflation rate and is adjusted for people getting in every quarter. So every 3 months, they look at what the inflation rate is and they adjust it according to the inflation rate. So because inflation was so high last year, it was 9.62%. Now inflation has dropped down, right? The goal for this is to beat the inflation rate. It's 6.89%. If inflation goes down again next quarter, then the return is going to be lower. So as the Federal Reserve continues to raise interest rates, the bank account and the CDs will continue to do better, but the Series I bond will not do better. So the timing for the Series I bond is now. Now, the problem, might not be a problem. The limit on the Series I bond is you can only max out 10,000 per year. There's no limit on the CDs and no limit on the cash bank accounts, but there's a limit of $10,000 on the Series I bond. Now, last year I got greedy and I did 8 months at the 9.62% and sat and waited, speculating that inflation might go up and I'd get a better rate, and end up getting a 6.2%, 8.9 rather, on the last 2 months. So this year I didn't wait. January 2nd, I just bought $10,000 worth of it, right, at 6.89% annual, because if they continue to raise interest rates, although the other stuff will do better, the Series I bond will start to go down. You won't lose money on what you already put in, but to enter, you'll get the lower rate. If that makes sense. I want to make sure that's clear. You're fixed at whatever you come in at. But if you don't come in at that time and it goes down, next time you come in, you're getting it at the next rate. So 9.62 was the highest it's ever been. We probably won't, hopefully, if inflation will never be that high, that we'll ever get that rate again. But this is extremely high and beats inflation. So you should definitely, and you can go to, I didn't put the site, treasurydirect.gov, right? So write that down, treasurydirect.gov. It's real simple. You set up an account and you can just buy right there, right from your bank account. You don't need the paper anymore. Everything, you can do paper if that's your choice. But if you could do paper, you got to go get it at a bank. If you don't do paper, then you can do it electronically. Shabazz, you have a question?
Yes, sir. This is a peace, Chief. It's a clarity question. So I know a bond is a loan. So because the interest rate is high, so that means there's a higher demand for consumers to loan money. I consider this probably is a bank, and that's why the interest rate is so high. So when the inflation goes down, the rate goes down.
Okay, there are different types.
Well, I put
No.
okay.
So I just want to make sure you're clear. This is the only bond. This is the only bond
Yes,
that
sir.
has a direct correlation to the inflation rate.
Oh, okay.
The only bond that has a direct, I mean, it's very direct, right? The others have an indirect correlation, meaning because inflation is high and stocks are low, then people tend to move their money towards bonds, right? There's a greater demand, and that raises interest rates. I mean, it raises the return on a bond, but the extremely high rate on the Series I bond was designed specifically so people can beat the inflation rate.
Oh, okay.
That's why it's better than, there's still the 30-year Series E, right? And
Yeah.
the key return, but it doesn't beat the inflation rate at all, right? So, and you got to wait 30 years for full maturity. There's a bug in here. Wow. You got to wait 30 years for full maturity. So I think the Series I, for now, right? And it doesn't mean you don't include any Series E in your portfolio. It's safe. But for now, for this part of the cycle, to maximize what you can get, the Series I bond just makes sense.
Okay. So is there alternatives less than 5 years in maturity for a Series I bond?
Yes. You can go with T-bills, right? Treasury bills. So Treasury bills, they auctioned off, and some mature in days, some mature in weeks, months, years, 1 month, 3 months, 6 months. But the interest rate is dependent on the duration of the maturity. So the longer the maturity, the higher the rate is going to pay. Right. So if it's a short, if it's a quick return, you'll get a return, but look how fast you get, right? Speed doesn't give you the higher yield, because the longer it's there, the riskier it is. So the more they pay. Right. So if you want speed and low risk, super speed, low risk, you get a low return. But Treasury T-bills are paying the highest yields they've paid currently, the highest they've paid in decades. So if you're going to do it, now would be the time to add it to your portfolio. So that's the alternative.
Okay. Thank you, sir.
No problem. For some of you who may max out on the I bond or don't really want to mess with the T-bills, they have bond ETFs too, right? So we talked about ETFs, exchange traded funds. They're traded on the stock market. You can get a bond ETF or bond fund, mutual fund that spreads across the board with bonds. And they do T-bills, I bonds, Series E bonds, corporate bonds. They have a whole slew of bonds. So they have diversification in the fund of different types of bonds. So, and I have a bond fund, and I got to tell you, the diversification is hasn't worked out the best for me, because I've done way better with the I bond series I bonds, far better, right? Because that's beating pretty much everything right now. The bond fund's not doing extremely poorly, but I have to wait, because it's something as a timer. You get the bond fund now, and as the economy declines, it will go up. So that's part of what you do too. You want to buy things when they're cheap. You don't want it to go up first and say, oh, it's up, I'm going to buy it. We know it's going to go up, right? And so even though the price is still slipping, it doesn't matter. You keep buying it as it slips, because it's going to turn around. That means like you got it on sale, right? So you have to look at it that way too. Don't wait for the thing to, because you don't know when it's going to hit the bottom. It's hard to predict when it's going to hit bottom, but we know it's already slipping. So buy it at the cheaper price, because we know also it's going to rebound and come up higher. So I've got bond ETFs. I got the Series I bonds. I got the CDs. I've got, high interest bank accounts, all of it, right? Because that's where the 90% is going to go. So let's continue. So that's where the bulk of it for most people are going to go. But now let's look at the 10% cheat sheet for this cycle. So while most people, again, have lost a significant amount of money in the stock market, I told you my personal portfolio that I put together gained 5.4% last year, when the average lost 19.8, right? So if 19% or almost 20% was lost in the S&P 500, but I gained 5.4%, what was the difference? I rebalanced my personal portfolio to remove all those tech stocks, or I should say minimize them. I didn't sell all my shares. I own a little bit, because they're going to come back at some point too. But I didn't buy any new tech stocks. I sold most of them, shifted to energy, shifted to consumer staples, right? So shifted to some medical. I got a medical stock that's paying right now, I think it's like 140% return. I've got energy stocks that are paying 78% return. I got even consumer staples like Campbell's and another one, General Mills, that are in the double digits. I got health stuff like CVS that are paying extremely high. So when you look at certain areas, and the energy stock, I like the energy stocks because they also pay high dividends. So my thing is, I don't carry a lot of the tech stocks anyway, because they don't pay dividends. That you can only gain from them when they go up in value and you sell them, right? And then you don't have the asset. So I like to hold assets that, when they're up or down, are profitable. So when they're up, they have a lot of equity. If I wanted to sell some, I can sell some, right? Like, so the consumer staples, if they go up late, they're doing pretty good, but consumer staples always pay me dividends. Energy pays me high dividends. I have some energy companies that are giving me 7% dividends, 9% dividend. Yeah, outrageous, right? Consumer staples, and I don't usually do anything that pays less than a 3% dividend. Right, so it's not going to be a part of my portfolio if it's not paying me, right? So it's the same concept when you're talking about real estate. If you're already in real estate, don't sell your real estate, right? As long as you're getting rental income from it, who cares about the equity? The equity is going to come back as long as something is paying you, right? So you want to have things in your portfolio that are not just equity producing assets, but also income producing assets. So even though their equity value goes down, they're still paying you an income constantly. So there's still plenty of room in the energy sector. There's still plenty of room in the medical sector, still plenty of room in the consumer staples to get both equity and income. So those should still be a part of your portfolio. And I don't care how much it costs for a single share. You don't have to buy an entire share, because now you can do fractional shares. So you can afford it, right? So if a stock, if you only have $500 and you want to spread that out over 10 different stocks, you can spread that $500 out over 10 different stocks, even if each of the stock values are $200 each. It doesn't matter, because you can buy a fraction. You can buy a fraction of each one and still get the same percentage return on your money. Right? It's not like you get less of a percentage return. You still get that same percentage return. You just get it on a different principle. So no reason why you shouldn't be able to buy a portfolio of stocks no matter how much you have. I think you can go as low as $25 on a lot of fractional shares. And if you don't want to try to choose individually because you don't know if your skills in deciding which company is good are on point, you can choose ETFs for each of those sectors. So you can get an energy ETF and it'll tell you what it paid over the last year. And it'll show you the chart year to date, what it's doing. And so you can get an ETF that has 10, 15, 20 energy companies or 10, 20 consumer staples. So ETF is cheap for that, right? So or you can do both, right? You can say, I want an ETF to get it diversified in that particular sector, but I also like this company, so I'm put a little more in there. So I want to weight that company a little more because it's doing better and paying me dividends. So where you want to steer clear of are the mutual funds right now. Mutual funds are doing extremely poorly and they're extremely volatile, and the volatility is what causes the fees, and fees are the killers, and taxes, movement is taxes. Those are the killers that will destroy your profits in a mutual fund. Index funds, because the tech sectors are dragging them down, index funds are on sale right now. So would I say don't do index funds? Absolutely not. But we're not going to heavily weight index funds, right? You'll see the stock market starting to come up again. So you can put small amounts in the index fund, just so when it comes back, you'll make a lot of money on it because you paid a lower price for it, right? But right now it's still very low and still, volatile, near the bottom volatile, not near the top volatile, near the bottom volatile. So if you're going to do it, it's just small amounts you put in your index funds. Peer-to-peer lending, you have to, now here's why I say it's in the 10%. There'll be a greater demand for people to borrow money. There'll be a greater demand for businesses to borrow money. There'll be a greater demand for investors to borrow money. So different crowdfunding companies will get a slew of applicants looking for money. You can create a portfolio of different loans with as little as $25 per loan. You're not even giving them the whole loan. You can add $25 in a lot of places to loan. Some of them you have to do $100, some, but most $25 per loan, and you can have a variety of loans. The issue is that because we're going in an economic decline, you will get a high default rate on a lot of the loans. Not a lot of them, not the majority, but you will get a high default rate on a portion of that portfolio, which means even though if they're paying high interest, you'll lose some, that'll get offset by the losses you'll get and the people who default. So when Lending Club existed, and they actually turned to a regular bank, and they have a high interest savings account now, by the way, I had 750 loans. I diversified my lending portfolio between 750 loans. And in the 750 loans, almost a quarter of them defaulted. However, the money I got from the 3/4 that didn't default was significant. It definitely beat index funds. It beat a whole lot of other stuff. But it's very risky. And again, your money's tied up for a period of time also because they have different durations of the loans between 1 year and 5 years, usually on those two. So you can make money on it. It's very risky. I had some loans where I got as high as 35%. Those obviously are the most risky ones. I wouldn't do anything under 10%. So I would do, the bulk of my lending portfolio was in the 10% range. Those are the least risky, good return. And then I had a small portion in the 25 to 35% range, the high risk. But believe it or not, the highest risk ones I had never defaulted. So it ended up paying off. The big 35% ones, I think I only had 1 or 2 defaults. And it was the lower risk ones that defaulted. So it actually balanced out nicely. So I ended up getting a good average return. So that's the cheat sheet. So if we go back really quickly, cheat sheet, cash. So we want high interest savings, high interest CDs, high interest bonds. You You can do the bond ETF to spread it out. Stocks, we're going to stay in particular sectors. We're going to try to do ETFs for now. Stay away from mutual funds. Dabble a little bit in the index funds. Peer lending, you can play with it a little bit, but that's really a small portion of your 10%. And real estate, I did put real estate on here in the cheat sheet because now is not the time, right? Because we know if interest rates are going up, it's going to force real estate prices to go down. And what's going to happen is the places that have been hardest hit, who were on the verge of coming back, like Baltimore, like Detroit, like Philly, like places like that, who were talking about making a comeback, are suddenly going to be stalled, and their prices are going to come down even lower. And they were already low, are going to come down even lower because they're going to be the least attractive places for people to go to. So there are places in upstate New York, there's Indianapolis, Indiana, there's St. Louis, Missouri, there's Baltimore, Maryland. You got all these places that are, like I said, were already down, trying to make a run to come up, hit by this economic down cycle, which is going to stall their growth and force them to bring their prices down even lower. And if you have cash, you can walk in and take those things. And when I say cash, there are properties in Baltimore for $5,000. There are properties in upstate New York for $800. There are properties in St. Louis for $1. There are properties in Indianapolis for $100,000, which are much better properties. But you know, when you have cash, you can walk in and get great deals on those things. So right now is the time to prepare for the bottom of the cycle to be able to scoop up the real estate, because that's where you're going to see the biggest growth when the thing returns. So say all that to say, timing is everything. So we live in a constantly changing economy. So being in the wrong assets at the wrong time will cost you everything. So if you buy real estate now, you're going to lose, I promise you. Because anybody who bought a property in 2005 or later lost until 2011. And so that same thing is going to happen again. If you don't take advantage, if you see the signs and you don't take advantage, like you missed the Series I bond when it was over 9%, but it's over 6% now. If you don't take advantage, you'll lose the profit because it's going to change. Series I bond is not going to stay there. T-bills are not going to stay where they're at. High interest savings accounts are going to come back down, right? CDs are going to come back to, everything's going to come back down at some point. When interest rates come back down because the inflation rate comes down and the stock market comes back, you're going to lose everything there. So it'll be time to shift. So timing is everything, and it's a constant work to pay attention to what's going on, recognize and understand the signs, and make the appropriate rebalancing and reshifting of your portfolio. That's a forever thing. There's no set it and forget it, you know. And I think most people have this misunderstanding that I can find the best investment that will survive any economy forever. It will not. You will constantly have to change. Let me just check these questions because somebody had questions. I see it. Okay, we hear a lot about municipal bonds. I wouldn't mess with municipal bonds. IRAs, that's a whole nother conversation. Yeah, we'll just go to that. That's IRAs or TDAs, 401ks, the same old thing. All right, so like I said, timing is critical. Timing is everything, but being able to recognize the signs and when to move and what to move into is also important. So I have a 4-week course that I'm going to teach. It's a 4-week part interactive course. So instead of me just lecturing, we're going to go back and forth. We're going to talk about it, and I'm going to talk to you about every aspect of it, from your initial setup to understanding every cycle to, you know, when to move. It begins January 25th, so that's next week. It's it should be 4 consecutive Wednesdays. 4 consecutive Wednesdays from 7 to 9 p.m. Let me just change that. That's weird. 4 consecutive Wednesdays. No, that's not right. You get what I'm saying. 4 consecutive Wednesdays from 7 to 9 p.m. There'll be, you'll get a video recording. So I'll send you the recording of the class and also the slides. So you'll be able to, you know, go home and follow along and catch what you missed. I will give you an investor resources list that has a lot of the different places you can go to find them, ratings for them, the different investments for different cycles. So to be categorized in this cycle, these are great investments. In this cycle, these are great investments. So it'll be a lot easier. These are the signs to look for. So you kind of look at your chart and say, okay, it's time to move, time to move. And I'll give you weekly action steps on what to do to get there. So again, what we're going to cover, how to build the appropriate portfolio to support your particular desired outcomes within a certain time horizon, how to evaluate the strength of a particular investment and the appropriateness of it being in the portfolio at that time, how to mitigate the risk using vertical and horizontal diversification, how to recognize the signs in the economy when it's about to change so you know that triggers your certain movements, and you'll learn exactly how to rebalance it so you know how to weight each thing, how to pull a little bit out of this at this time, add a little weight to the next thing at the next time. That's how you're going to maintain profitability, whether the economy is up, down, or stagnant. It doesn't matter. You'll always make money, and you'll always be able to average at least that 10% or do better. So how much is it worth? So how much would you pay to gain the knowledge and the tools and the support, which is really important, to make your money grow forever, right? And that's the key. Let your money grow forever. How much is it worth to you? Now, I'm not going to charge you $1,000, though I think it's well worth $1,000. I'm not going to charge $500, even though I think it's well worth $500. But I'm also going to give you 100% money back, no hassle guarantee. I don't care if you use it or not. If you just say 1 year, within 1 year, because it takes a year to, figure out whether or not you want to use it or it's good for you or not. And within that 1 year, if you say, give me my money back, I'll give you every penny back. I don't care whether you used it or not, profited or not. If you say, Haru, I want my money back, I'll give you every dime back. So 100% guarantee, and it's only $399. So that's a steal for that. But I'm going to throw in a bonus. So some of you who know me for a long time know during the last recession, I wrote a hot book called Recession-Driven Riches. I'm going to throw in, if you register today, I'll give you an e-version of the book. So you'll get a digital download of my book, Recession-Driven Riches, that not only tells you what to do to save your money, but also how to make money during an economic downturn. So when this thing hits rock bottom, it has all kinds of ways for you to capitalize on the way the market will change. So the book is still relevant today. As a matter of fact, I have a crazy thing. I have publishers calling me weekly who want to buy the rights to the book now because we're going in a recession. So the book is still relevant. I'll give you a copy of that. So to register, if you want to register right now, get the copy of the book. I'm gonna leave that on the screen. You can go to the link, this link right here, just buy.stripe.com, follow this letters, and you can do it immediately. If you need a payment plan, because I know some of you, money's a little tight, and I don't think $399 is crazy. I tried to keep it in the affordable range. But if you do need a payment plan, just email me. You can email me at Harua Insiders Group and put in the heading payment plan, and then we'll have a dialogue and we'll talk about a payment plan that makes sense for you. So I'm very flexible on that because I really want you to have this information, and I don't want you to miss out because your money's tight, right? Because if your money's tight, you really need this. So I'm going to leave this up here again. If you want to register now, again, it's 4 weeks. It starts next week. I'm going to give you today. I can only give you the cheat sheet for what's coming, but I'm going to give you more than that for what's coming, but every cycle, and give you to equip you with the tools for you to be able to recognize it yourself and be able to find and be able to analyze what a good investment is for you. So please register right now.